In this video, I'm going to explain my simple quantitative strategy that I believe is going to crush inflation over the next several months. And I'm also going to invest over $10,000 of my own money into this strategy right here in the video. So first of all, in case you haven't felt it in your own wallet, inflation is a real problem right now. With the release of February's CPI Consumer Price Index data, we hit a 40-year all-time high. And then we hit another 40-year all-time high again with the release of the March data. And in about 2 weeks, the April data will be released, and many people are expecting this to be another all-time high. So inflation is rampant, inflation is out of control. Where can investors go to get some alpha? It's certainly not cash. You're not going to beat inflation in cash. So let's look at this chart right here. Use this as our starting point. On this chart, I've got the S&P 500 and 10-year treasuries represented by the reflective Vanguard mutual funds. And we can see year to date, so basically what is at this point as of recording this, it's March 29th. This is the first quarter of 2022. Stocks have had a very, very bumpy ride, going down more than 10% at one point, now rebounding. So over this time period, they're actually not down very much, but they did have a pretty big drawdown in there. It's been a turbulent, bumpy ride in stocks through this first quarter of 2022 while we're experiencing the inflation. And then treasuries or bonds, 10-year treasuries specifically, what I'm looking at here, is also getting crushed. Year to date, it's down 5.21%. That is a huge drawdown in bonds in just a 3-month period. Bonds are typically regarded, or 10-year treasuries specifically, are typically regarded as the crisis alpha asset. When things get rough in the stock market's going down, 10-year treasuries is typically where investors flock to for safety, and subsequently they typically spike. We saw this from 08 to 09 during that big crisis, the great financial crisis. The best place to be there was in 10-year treasuries. During the COVID issue from March 2020 to maybe June 2020, 10-year treasuries did very well there. But right now, with inflation being so out of control, 10-year treasuries are not a good place to be. So where can we as investors go to actually beat inflation? Well, I did a video on this a few weeks back, which you can see here. I will link to it below, but I'm going to summarize it in a second. Before I do that, I want to shift gears and talk about the concept of economic climates as proposed by Ray Dalio, the hedge fund manager, famous guy for being the manager of the Bridgewater, right? Bridgewater? Yeah, Bridgewater hedge funds. Correct me if I'm wrong in the comments on that, but I'm pretty sure it's Bridgewater's hedge funds. Okay, so he proposes there are 4 economic climates. There's economic expansion and there's recession. There's inflation, and that's higher than expected or average inflation. And then there's deflation. Now, this is not really deflation, but just lower than expected or lower than average inflation, right? Because, our average inflation rate, let's just say, is 2%, but if we're in a 1% environment, that would fall down here, right? Where we have lower than expected or lower than average inflation. And these terms, depending on which documents you read on it, these terms are used interchangeably. Okay, so what asset classes perform well in these economic climates? Well, according to Dalio, and also Harry Brown talks a lot about this in his permanent portfolio, which is very similar to the all-weather portfolio. During economic expansion, stocks do well. So let's change the color of that just so it stands out. Stocks. During recession, cash. Cash is really, typically the only place you can go to avoid issues. I guess you could go to shorting, or shorting markets and stuff like that, but that's a whole nother topic. This is a simple level. Then during inflation, he proposes gold to be the asset class to be in. And then deflation, bonds. Okay. So these are the asset classes that are intended to do well in these specific economic climates. Obviously, for this video and the focus of this strategy, we're talking about inflation. So gold is what is commonly referred to as the best inflation hedge, but that is not always correct, right? So as I found out here in looking at the data here and some of the details in this video, gold does not always do well through all periods of inflation. This chart actually shows it well. I didn't intend to talk about this here, but From 1973 to 1979, gold rip-roared up during that period of inflation. But from 80 to 84, it was losing. And then 88 to 91, it was also losing. So gold is not single-handedly the best hedge against inflation out there. So what is? Well, if you go through and watch this video, I explain it in some more detail and look at some more reports. But basically, to summarize it, let's see if I can move this over. I'm not too good with my tool. There we go. I'm just going to put best assets for inflation. There's basically 4 of them, and gold is one of them, but none of them do well all the time, right? So that's why it's important to consider a basket. There's gold, energy equities or energy stocks, commodities, and real estate. So as a basket, these 4 assets do very well during inflation. They don't all do well at the same time. There might be some periods of inflation where one really outperforms the other. In the late 70s, gold really outperformed a lot of them. And then onward, energy and commodity did. And then real estate generally does pretty well through all periods of inflation as well. But the important thing to take away from this is that there's not one single asset. There's not one single asset that we can point to that's going to say this does good during inflation every time. It's a little different every time, but broadly speaking, this basket right here will do very well during inflation. Okay, so what I propose here is holding an equal weight basket of each one of these asset classes. So 25% gold, 25% energy equities, 25% commodities, 25% real estate while we are in an inflationary period. Okay, so then that brings us to the next topic. How do we define an inflationary period? We could look at the CPI and do that, but I propose a very simple method, and a very simple method that I'm very familiar with. And that is using momentum or relative strength. In other words, what has done better over a period of time? Would it be our basket of commodities, or not commodities, but our basket of assets for inflation, which is largely commodity driven, or would it be bonds, right? So just look at them over a recent period of time and invest in or hold your position in them until one outperforms the other. Okay, so for example, let's go back to this chart right here, and I'm going to put those asset classes on there represented by low-cost ETFs. So for energy, we would use XLE, and these are the lowest cost ETFs that I could find. Oop, that didn't work. All right, there's energy. Next up, let's add REITs. We're going to use SCHH, which is Schwab's real estate ETF. And then we'll add gold, ticker symbol SGOL, the lowest cost gold ETF out there. And then for commodities, we're going to use ticker symbol USCI. Now, this is not the lowest cost commodity ETF out there, but there's 2 reasons why I use it. Number 1, a lot of the commodity basket ETFs include exposure to gold. But we don't need that because we're treating gold as a separate holding here, right? So we don't want to have any more gold exposure in the portfolio through a commodity ETF. USCI does not have any gold exposure in it. And then there is the issue of a K1. A lot of commodity ETFs generate a K1, which adds another layer of pain in the ass onto your tax return at the end of the year. So with this ETF, USCI, we don't get a K1. So let's put that on here. And we can see year to date, energy up 39.26%, commodities up 26.77%. But the period of time I'm going to use for this relative strength metric is 6 months. Okay, and over this period of time, we can see 10-year treasuries are down 5.73%. We want to compare that to our basket of assets for inflation, which is going to be the energy, real estate, gold, and commodities equal weighted. So to do that, what we're going to do here is take the average of them. So we'll just add them all up, 48.02 plus 10.006 plus 9.86 plus 34.77. We will add them all up and then divide them by 4 to get the average. And again, we're equal weighting this basket here. So this basket is up 25.67% over this 6-month period. So over this 6-month period, it has grossly outperformed 10-year treasuries. So what that would mean is for this strategy for the upcoming month, we would stay invested. And then at the end of the month, I will look at this again over the last 6-month period and see how this basket of assets has done versus the 10-year treasury. If this basket is still outperforming, and quite frankly, I expect it to, at least for the next month, we will stay invested in the basket. If it is not outperforming 10-year treasuries over the 6-month period, then we will exit our position. Okay, so we can summarize this, in written form with simple rules here. Let me just slide over in this tool I don't know how to use too well. And we will just put strategy rules. And then let's do a bullet point list. Not that we really need a long list here, but if total return of basket greater than 6-month return of 10-year treasury, stay invested in basket. Okay, and then on the flip side of this, if total return of basket less than 6-month return of 10-year treasury, exit. Now, since this will probably come up, what are we going to exit to? Now, personally, for me, that just means I'm going to put the money back into my broad market asset allocation, right? I'm just going to end this strategy. I will have ended my time in this basket of inflation beating assets, and I will go back into my broad market asset allocation. Some people might say, well, maybe you could go to 10-year treasuries, but you really wouldn't want to do that because I've put them all up here on the chart, and you wouldn't want to, do this strategy long term because we're usually not in an inflationary environment. This strategy really only works for the period, or would really only work for the period of inflation that we're in. I put all of these asset classes on this chart right here, equal weighted, and you can see that from 2011 to 2021, when there was really, not any above average inflation or above expected inflation, it really went nowhere. It was literally a sideways 10 years for that basket of asset classes. Real estate, gold, commodities, and energy. They kind of went nowhere during this period, right? So you wouldn't want to, just trade this strategy long term. This is just something I'm using right now because inflation is a problem. And we're clearly in an inflationary environment. Now, let's also touch on this. Why 6 months? Quite frankly, that's just an arbitrary number that I plucked out. I've studied these relative strength and momentum strategies for a long period of time, and I would say that there's going to be a broad parameter of stability anywhere from 3 months to 18 months, right? So if you wanted to use a different period of time, you could use it and you'd probably do about the same. It's just nice here with Morningstar because you can just click on 6 month and, get the data real quickly and see it like that. So that's why I use it. But yeah, you could do 10 month, you can do 12 month, you could do 18 month, you could do 3 month, and you're probably going to do about the same. Now, one other thing I need to point out here before I actually jump into making my investment is I don't know where, in this environment I am, right? Like you see this here, and clearly energy and commodities have rip roared up, but I could be a little late to the game. Maybe the time to invest in this was back here in probably early January. I mean, let's just set that right here, drag it back a little. Yeah, so right here, if you were to look at this for January 2022, definitely based on these numbers, if you were to do the 6 month average of everything, these assets, the basket, the inflation basket would clearly be signaling you. It would clearly have a higher 6-month total return than this of 10-year treasury. So it'd be signaling you to get into it at that point. But, maybe I'm a little late to the game. Quite frankly, I don't think I am. I think we're going to have a big headwind of inflation. And that's something I'm speculating on. And that's something that I'm comfortable making the bet on. And that said, what I'm going to be investing into this strategy is a relatively very small part of my actual portfolio. So on that note, guys, let's jump into my brokerage account and I'm going to plunk some money into this strategy. Here we go. For this investment, I'm going to use M1 Finance as the brokerage, and I actually plan to move a lot more of my holdings over to M1 Finance in the near future. There's a few reasons why. Number one, M1 Finance has no fees. Number two, M1 Finance lets you create these awesome little pies, as they call them, which hold your asset allocation. So all you have to do is transfer your money into the pie and then it distributes evenly among your asset allocation. Here I've created what I'm calling the Corey Inflation Alpha Pie, which holds the 4 ETFs I'd already discussed in equal weight at 25%. That's SGOL, XLE, SCHH for real estate, and then USCI commodities, right? So I could set up an auto investment amount and it would invest evenly into these ETFs. What is also cool about it is it does fractional shares. So if you're using a lot of other brokers, you're limited or you're constrained by share price, right? If SGOL is at $150 in share price, and I don't know what it is, you can't invest less than, say, $600 in the whole strategy. And that assumes that all of these would be at $150. Right? With M1 Finance, you can invest it and it's going to give you fractional shares to match your percentage of allocation. And you can open an account on M1 Finance with $100 minimum, and you can invest less than that as a contribution into the pie. So it works out great for small amounts. It works out great for uneven amounts. If you've ever tried to manage an asset allocation using shares or even mutual funds where you don't need to worry about shares, it can be kind of, I don't want to say confusing, but just a pain in the ass to have to split it up and allocate it, among your total investment and initiate 4 trades for each one of them. With M1 Finance, you can do an auto invest. You can just simply say, like what I'm going to do, click transfer and distribute it all into the pie. Now, one thing I should clarify here is this is not a high frequency trading type of platform. Right? So even though I am using this to hold what is an active investment or semi-active investment, I plan to have this holding for a few months at least, if not several months or longer. Really depends on how long this inflationary environment goes on. But at that time, I'll be able to liquidate it and I can just redistribute this into either my buy and hold allocation or another allocation that I have here on M1 Finance. So you don't want to sign up for M1 Finance if you're day trading. But this little strategy right here where it's kind of enter and at some point in the future, which may be, at least a month in the future, most likely it'll be several months, if not longer. It is fine for that. The other 2 cool things about M1 Finance is that you can withdraw on margin, or they give you a portfolio line of credit. It's a little different than margin, but pretty much the same thing. Technically it's different, but fundamentally it is the same thing. Am I saying that right? Technically it's a little different, but it's basically the same thing, at least on the top level. You can withdraw and use the money or borrow the money to use however you want. I've got a whole video on how I use margin loans at very low interest rates here with M1 Finance Pro, which I signed up for. We can see it, or not M1 Finance Pro, but M1 Finance Plus. You can borrow at 2.25%. That's annually. So if you want to take out some money for a few months, you're going to pay less than that. If it's 3 months, you're going to do this divided by 4, 1/4 of that. The margin rates here are very, very, very low to borrow against your portfolio. I'll link to the video that I have on margin loans and how I use them. And then, of course, they offer some sweet incentives by signing up here and making a deposit amount. Like I'm going to do a little over $10,000. I will get a bonus of $150. So that is not, the end all be all. I would still do this if you didn't have the bonus, but well, I'm going to collect my bonus and enjoy. So on that note, guys, here we go. I'm going to invest $10,325 into this one-time transfer. We're going to go from my bank to that inflation alpha pie. I got to do at least $100 is what they're saying here to fund my account. $10,325. Let's make sure the number is accurate. Transfer usually completes by the next business day. So I don't know if it's always going to be a business day or if, once I get going with them after my first transaction, it will happen quicker. That's a good question. I should probably ask. but it doesn't really matter to me if I have to buy in today or tomorrow. I'm still doing this here. 10,325, bingo, confirming it. And there's my pending transfer. So that is done. And well, it's going to go into this pie once it actually completes the transfer. We can see it right here. And here are the trade windows. So M1 Finance does not trade instantly when you click the button. They trade at 9:30 a.m. That is the default for all accounts. If you're using M1 Plus, which costs, how much is M1 Plus? I think it's like $125 a year. I signed up for it. Yeah, $125 a year, 1 year free trial. So I signed up, I'm on the free trial, and then it's $125 a year. But if you're using the M1 Borrow, like I use to fund business investments, it, with that low interest rate, it's certainly going to pay for itself. And if you're using M1 Plus, bottom line is you get a 3 p.m. trade window. So I don't think it's going to trade for me today at 3 p.m. because the money is not linked to my bank account and this is my first transaction, but the money will be in here. So going forward, this gives us the opportunity to follow and review my portfolio. So I am going to make a lot of update videos. I don't know how often I'm going to do it, monthly, quarterly, but at some point in the future, I'm going to make some updates just so we can follow this strategy and see how it does. This is something I plan to do a lot more going forward and something I really wanted to do when I first started the channel. So expect to see more videos like this where I describe my investment strategies, make the investments, and then, hey, we can follow along, and in a couple months I'll be saying, hey, maybe I put another $20,000 into this strategy, another 30, 40, whatever it is. Maybe that's a little high. I don't know. Whatever I contribute, we can say, hey, here's my contributions, here's how the portfolio is doing, and see what happens. That's fun stuff, guys. What do you think about this strategy? Let me know in the comments below. I want to hear your thoughts. Good strategy, bad strategy, money move or Muppet move? I like that term, money move or Muppet move. Which one is this? Is this a money move or money move or Muppet move? Let me know in the comments below, guys. I will also include a link to this M1 Finance pie. I will share it with you guys. So if you want to invest in this, and get started on M1 Finance or make the similar investment, you'll have access to the pie. I'll put that in the link below this video. That's a wrap on this one, guys. I hope you found it helpful and insightful. I am signing off on it.